All right, in this video, I'm going to look at excesses, look at how I read the market structure in the last few days, and also point out liquidation breaks. As I came into the market from Friday, I just looked at Friday's chart and I saw that there's a prominent point of control here at 33.67. So that's just something to keep in mind going into the week, and that's something that I had written down in my notes. So the concept of excess is used to indicate whether or not an auction is finished. And this is a concept that uses time to really make that definition. I think the best way to do it is just to look at an example. So what happened from Friday to Monday is that price opened Monday morning a little bit below the point of control from Friday and more or less coinciding with the lower the value area low from Friday. And price opened here and spent very little time here. Basically what happened was the market saw it as an unfair price when it opened here at 33.62. And during that first 30 minutes, denoted by letter A, it moved up about 20 points. So that's a pretty significant move that defined that initial balance range. And then price stayed within that range pretty much the rest of the day. So the concept behind excess here is that, again, because we're using time, it quickly moved away from a price. This price was the open price in this case, and it quickly moved away and left this single trail of prints. And basically the way to think about these A's down here and these single prints is that it's an area where the market participants saw prices being excessively low or excessively high. And in this case, this excess shows that price was excessively low, and what happened was they drove price straight up. It reached its pinnacle here during the A time frame, and then it pulled back. My cursor's moving much slower. And then it pulled back here during the B period. So this is a really interesting thing to look at. I'm going to pull it out, but I want to finish just going through what this excess means. And so what I'm going to do, just to keep notes in view, is write that excess, I'll write in letter A's, and I'll just say excessively low buyers came in. So again, they saw that as being a good price, buyers did, and they moved price up. So keep that right there. So I went through what excess is. The opposite of excess is going to be when there's not excess. And so looking at Friday's chart, you can see that whereas excess is shown by this single print buying tail, here, my cursor's going slow again. Here on Friday though, you can see that when price went up there during the I time frame, it actually stayed up there for a little while. And because they spent those two different 30-minute periods up here, and that was the peak, you're using that to identify what's considered an unfinished auction and no excess. I've got Jim Dalton's book here, and I'll read that he says, "The lack of a tail may indicate that the market has gotten too long when there's no selling tail and too short when there's no buying tail." So this is a buying tail, so it doesn't apply here. But there's not a buying tail on Friday, and that's considered a poor high. It's a place that the market could go back to. It's a place that indicates that auction wasn't finished there, but it's also a place that likely buyers came in, and what happened was, because it was a poor high, it didn't hold. Buyers, essentially what happens during these liquidation breaks, albeit a small one in this case, what happens is that buyers who got in up here, because we spent more time up here, more buyers likely came in. Because they're long and price starts to come down and they're weak hands, when price comes down, it shakes them out. They get very panicky. Short-term traders get panicky here. They see that, they're in over their heads. They think that they are starting to lose more than they anticipated, and that, triggers these very quick late day breaks. In this case, it wasn't quite as quick actually, but it was a mini liquidation break. So then I'm going to move on to Monday. So this is Monday. We already went over actually Monday, so you can see that there was excess here. this swift movement up shows me that here at 30 in the low 3360s, there were strong buyers here. And that's what happened on Monday. Going to Tuesday, though, we had another little liquidation break. In this case, it was much harder to detect. But the thing that I took away from this was that when it came down to more or less this 3363, 3367 area, this area I've been talking about, buyers stepped back in. And so there's still buyers there. I'm going to go back to Monday too, because I'm just curious. So this is another thing I wanted to bring up, and I think this is a perfect example of it right now. But whenever I post something about buyers or sellers or traders being too mechanical, that's another way to start analyzing some of these highs and lows. So in this case, sellers or buyers came in, drove price up, and when price pulled back, you can see B here is when buyers came back in, and that coincides perfectly to a tick to this poor high from Friday. And it happened again here in the L period. So more or less, we have this line running through here. It's a poor high. It means that people are continuing to come in, get long, but then nothing really happens. But interestingly, when the pullback occurs, they continue to buy it up. In the case of Monday, you can see that this left what you may consider a single print trail. I would say that this is the important single print trail here in A. What happened during B was that when we pulled back directly to this mechanical visual point here from Friday, we stayed back up above that point. We already knew this was a poor high, and still buyers are just buying it up, buying these dips up, keeping it elevated, keeping price elevated. Going back to Tuesday, again, we already know, like I just mentioned, that buyers were starting to get too long in this area. Price opened here Tuesday morning, went up, triggered another break, and we saw buyers step back in here. Then moving to today, Wednesday. So I'm moving here now. Another exact same pattern happened. I'm going to pull these out. You had buyers still defending this kind of imaginary line. We were coming into this day knowing that there were poor highs here, poor highs, my cursor's behind, poor high here, poor high there, another poor high here, no excess. Price spent a fair amount of time through these lines here. And again, we had this very mechanical buying here at A, came down, so we opened at A here, came down, bought at this very mechanical level. Kept back up above those. So I'm going to pull this out too. So you can see that we've got this kind of area where they're defending. And again, the same thing happened today. We had a poor high. They held on as long as they could up through this area. Very little extension. And yet again, the bottom dropped out. Price fell down to almost the exact same place as yesterday. And what you've likely got here is an auction that's not finished either to the downside or to the upside. It's just poor structure at this point. And so those are what the liquidation breaks look like. And these are, as you can see, as we went through that, there's a lot of different data points to carry into the week and carry into what you're, to put into your notes and then to have those with you. And I think that these are all important data points, but also helps you to read the market after close. And so this is what I'm talking about when I talk about the notes that I'm putting down. And it takes a lot of time. It takes a lot of time to do. So the final thing to mention, and now that I've gone through this whole scenario from this week, oftentimes when the market gets to these poor highs, those are held by weak hands. So every time weak hands, short-term traders come in, they're momentum traders, they get excited because they see price continuing to tick up, continuing to go higher. And what they're doing is they're all getting excited, they're getting emotional, they're driving price up, they're keeping price up, but you're going to get these liquidation breaks because these are really these are really traders who have weak hands. They need to be forced out sometimes to help a market go higher. You can argue that this is going to make the market stronger in the long term, but what we've seen so far is this a lot of ping ponging around and weak hands in the market. So that's it. That's it. I'm going to keep it there. I'm going to try to keep it simple, but I think having a visual of this is going to be really helpful for a lot of people. And thanks for watching.